If you've ever used Bollinger Bands in your trading, you know they're a classic for a reason. But what if you could take that classic tool and supercharge it with a layer of mathematical precision for a way clearer view of the market? Well, today we're going to dive into a really powerful evolution of a trading staple.
So, let's get right to the heart of it. Do you ever wish you could map out market volatility with just more accuracy? To see not just if a market is overbought, but, how overbought it is. Well, this is the tool designed to do exactly that. What you're looking at might look like regular Bollinger Bands, but there's a key difference. Instead of being built on standard deviation, these are based on Fibonacci ratios. The whole point of this combination is to give you a more nuanced, more dynamic view of what price is actually doing.
Okay, so let's break down what this thing really is. At its core, it's an advanced indicator that takes a concept you're probably already familiar with, but it swaps out a key ingredient, standard deviation, and replaces it with a mathematical harmony of Fibonacci ratios. And that swap is what creates this much more refined tool.
So let's just run through the key characteristics. First off, it's an advanced volatility indicator. The big deal, the crucial difference, is that it uses Fibonacci ratios instead of standard deviation. Now, it's built on two very common tools you probably already know, a simple moving average and the average true range. When you put them all together, they create these dynamic zones that act like support and resistance, all with the goal of being way more precise than the traditional bands.
Okay, I know what you might be thinking. The word formula can sound a little intimidating, right? But stick with me here, because the logic behind this is actually super straightforward. It's built on two simple, common components that most traders already use. Let's just peel back the layers and see how it's all put together.
First up, you've got the simple moving average, or SMA. The easiest way to think about this is as the indicator's center of gravity. It's the baseline, usually a 20-period average that shows us the middle of the road, the central trend. Everything else is built around this one core line.
Next, we bring in the engine of volatility, the average true range, or ATR. So if the SMA is the center, the ATR is what gives the bands their width. It measures how much the market is actually moving. So, in quiet times, the bands get nice and narrow, and when things get crazy, they expand.
And here's how easy it is to put together. You start with your baseline, that 20-period SMA. Then you figure out the market's recent volatility with the ATR. From there, you just multiply that volatility number by a Fibonacci ratio, add it to the SMA for your upper bands, and subtract it for your lower bands. Seriously, that's it.
Let's put some simple numbers to this to make it crystal clear. Let's just say the SMA is at 100, and the ATR value is 2. For that first upper band, you just take that ATR of 2, multiply it by the golden ratio, 1.618, and add that to the SMA of 100, and boom, you get 103.24. The exact same logic applies for all the other bands, creating this really precise map of volatility levels. Okay, so now we know how the bands are built, but what do they actually tell us when we're looking at a chart? Let's get into translating these lines into potential market signals.
This right here is the key to using this tool. Think of each set of bands as a different zone. The first bands, the ones based on the 1.618 ratio, that's kind of your normal extension zone. The second bands, at 2.618, that's signaling a strong overbought or oversold condition. And if the price ever reaches those third bands at 4.236, well, that's telling you you're in an extreme, maybe even unsustainable market move.
Now here you can see it on a live chart. The logic is so simple. The farther the price gets from that middle SMA line, the more extended it is. When it starts touching those outer bands, it's a big clue that the price has moved a really significant distance compared to its recent volatility, and it might be due for a rest, or even a reversal. All right, now for the part you've been waiting for. How can you actually use this to find potential trading opportunities? We're going to walk through two classic setups, one for going long and one for going short. First up, the buy setup. The whole idea here is to identify when a market might have been pushed down too far, when it's getting oversold, and it might be ready to bounce back up. So what are you looking for? Here's your simple checklist. First, you want to see the price actually touch one of the lower bands, showing that it's entering that oversold territory. Now for some extra confirmation, you can check if the RSI is below 30. And finally, you wait for a bullish candle to show up. That's your signal that buyers might be stepping back in, and that's your potential cue to act. And here is a perfect picture of that setup in action. You can see the price takes a dip, touches that lower band, signaling an oversold condition. Then boom, a reversal candle forms and the price starts heading back up towards the middle SMA. This is the pattern, playing out right on the chart. Okay, let's flip the script and look at the exact opposite scenario, a potential sell setup.
This time, we're on the hunt for signs that the market is overbought and might be due for a pullback.
And the checklist is just a mirror image of the buy setup. We want to see the price push all the way up into the upper bands, ideally that second or even third zone. An RSI above 70 adds some nice confirmation that things are getting overheated. Then you just watch for a bearish candle to pop up, suggesting the rally is running out of gas. A really logical target for a trade like this would be a move back to the average, that middle SMA.
This chart is a fantastic example of a sell setup. Look how the price rallies hard, pushing right into that upper volatility zone. That's a huge signal of a potential exhaustion point, and as you can see, the price stalls out and then starts to pull back towards the center. It's a classic mean reversion setup, just identified with a lot more precision. So to bring this all home, why should a trader even consider adding this tool to their charts? Let's just do a quick recap of the key advantages that make it so compelling.
You know, if there's one word to take away from all this, it's precision. This tool helps you identify those overbought and oversold zones more clearly. It shows you dynamic support and resistance levels that actually move with the market's volatility. It helps you gauge trend strength, and ultimately it helps you plan your entries and exits with a much greater degree of accuracy.
This quote really just sums it all up perfectly. It's a powerful tool that combines trend, Fibonacci, and volatility, all with the goal of improving your accuracy on both your entries and your exits. It's really about bringing these powerful concepts together into one single cohesive visual.
And that leaves us with one final question to think about. How might having a clearer, more mathematically precise map of market extremes, the normal moves, the strong ones, and the truly unusual ones, how could that change the way you approach your own trading decisions?